everybody settled in. I think it's kind of ironic that they put an oil and gas company right after that presentation. But I think there are a lot of things that I can talk about how our business has changed to be more sustainable in the long term, and some of the things that we're doing. I see a lot of familiar faces, and we were here about a year ago, and so what I'll also do is talk to you a little bit about what's happened since then, and maybe give you my view of where I think this industry is going over the next 30 or 40 years as well. So let me start out. First of all, Touchstone is duly listed on Toronto and on AIM. We listed a year ago next week, and I'll show you a bit of the results since then, but it's been fantastic for us, and I think it's been fantastic for our shareholders as well. But our goal is to be the largest and most profitable oil producer in Trinidad. Just a quick summary, why Trinidad? It's on the up-dip end of the Venezuelan basin. The Venezuelan basin is the third largest oil reserves in the world. It's a country in a mess, but that's why we're not in Venezuela. That's why we're in Trinidad. And the other thing we want to be is we also want to be the most profitable one, and we'll show you how we're doing some of that as we move along. The other thing about Trinidad is it has the largest refinery in the Caribbean, about 150,000 barrels a day. It's the main supplier of jet fuel for all of the Caribbean. It has the sixth largest LNG plant in the world. It is an exporter all around the world of liquid natural gas. It has the largest standalone methanol plant, and Methanex's largest plant is there. So I kind of joke when I say this, but it's a little bit like a Mad Max movie when you're there, because a lot of this stuff was built in the 1950s and 1960s. So you see a lot of these old plants around. But they are actually been upgraded to be quite effective, quite efficient now. But it's also a huge demand for both natural gas and oil right on the island. So from an oil and gas guy's point of view, it is a great place to be. We'll move forward to what we've talked about, and we specifically picked this growth chart where you see it go up a little bit, down a little bit, and go up a little bit. And I think that happens in our business, but the key thing is to survive. And most of our competitors, a lot of our competitors through the last down cycle just simply didn't survive. They're not around anymore. When oil hit $28, a bunch of them disappeared. That gave us the opportunity to pick a bunch of them up. We had about 5 properties going into that downturn. We now have 20 properties in Trinidad, so it was a great opportunity for us. So value creation, we'll talk about it, but this is a cash flow positive company. This is an earnings positive company. And it's got a great balance sheet, less than 1 times debt to cash flow. We'll talk about that, but there's really hardly any net debt on the balance sheet. We have a huge resource in Trinidad. There's about 6 billion barrels of oil in place in Trinidad. So there's tons of oil to come out of this. The 208 drilling locations that we've got, we could drill about 20 wells a year in Trinidad. So what that means is we've got about a 10-year drilling inventory in Trinidad. And then the other thing that we just rolled out about 30 days ago, not even that, I guess it's only been a couple of weeks, is some huge exploration opportunities that are onshore that we've come up with in the last couple of weeks that we're going to drill in 2019. And the reason we're just finding them out now is because it took us a couple of years to do all the research on it and get it going. So let me walk through this. What I want to do first, though, is I want to talk about why we think over the next 20 or 30 years this is still a really good business to be in the oil business. So the red line is the price of oil over the last, basically, since 2013, run a pretty solid. We all got pretty comfortable it was going to be $110, and then we woke up and realized it wasn't going to be $110. And I'm an economist by trade, and there was a lot of conspiracy theories about what was going on with oil, but to me it was pretty simple, just supply demand. We started to get way oversupplied in the market. That drove down prices pretty dramatically. And then we saw in 2016 combination of Russia and OPEC getting together to take some oil out of the market. But the other part of that component was capital programs also got shut down around the world. Any new projects coming on got shut down. And what we're now seeing is that coming back into balance, where as of today, we're probably a little undersupplied, in my opinion, about 1 million barrels. I think OPEC will probably throw some back on the table here tomorrow, maybe 300, 600,000 barrels, somewhere in that range. And that'll bring us back into supply. And you can see that oil's come back up to $70 where we're at today. The more interesting slide for me is where demand, I think, is going. I agree with the idea that electric vehicles, all that's going to come into the market. But there's really sort of 4 different schools of thought. if you want where oil consumption is going to be in 2030, 2040, and you look out there and pick your number, whatever it is, but let's say it's 130 or 140 million barrels a day. That's a 40% increase from where we are today. That means we got to find 40% more oil than where we're actually producing today, less declines as well. It's a mind-boggling concept when we start throwing around excess capacity in the market of 1 million or 1.5 million barrels. Not very far from now, we're going to be looking for 10 or 15 million barrels. I'm not saying oil's going to $200 because I think technology will offset some of that, shale oil, all of those other things. But there is a huge demand for oil as we go forward. The other interesting fact for this year, it's probably the biggest takeaway for me this year, is this will be the first year in history, and it's probably about now, that oil consumption is now about 100 million barrels a day as of today. It's about 100 million barrels a day. And more interesting is this will be the first year that there'll be 100 million new vehicles sold around the world. So it's big numbers when you think about where this is going. And that will be less than 1 million electric vehicles will be sold this year, so less than 1%. So it gives you an idea of how big that gap is and why we think it's a pretty good business going forward. So the 4 pillars for us, one is our people. When oil hit $28, we completely collapsed our infrastructure. We went from 178 people to where we're at about 76 people in Trinidad and 14 in Canada. We have now what I would call a social license to operate. We have no expats on the ground in Trinidad. It's all local content down there, and it's worked out exceptionally well. I will admit a big chunk of that was just to reduce overhead, but it's actually worked out really, really well. The universities have responded, the tech schools have responded by giving us just terrific people out of their programs. We are 100% in Trinidad. It's a very focused oil operation in Trinidad. As I talked about, we're now the largest landowner, and we've got about a 10-year drilling inventory. Our current production is about 1,800. When I was here last year, we were about 1,100, so we're up 50–60% from last year, and the goal was to be through 2,000 by the end of this year, and it looks like we're going to do that probably by the end of the summer, and I'll show you some charts on that. We listed on AIM. We did a small raise in June. We did a larger raise in December, and that was really the turning point for us. What we needed to do was get properly capitalized. We had this huge land base. We had bought up all these properties. What we needed to do was start drilling wells, and that's what we're now doing. So if you take a look at the share price, and this is just basically a comparison to our peer group. So this is sort of the same dollar in at the same point in time, June of last year. You can see this is ours is the dashed line, the oil and gas, other comparables on the AIM is blue, and then AIM overall is the red. So we've outperformed our peers as well as the index. And I actually still think when you look at us, we're fairly inexpensive because we've got a really clean balance sheet and we've got this huge inventory of opportunities. We also get paid in US dollars, and our costs are in Trinidad TTs, which is quite low. So there's also a nice spread between the two. Just talk a little bit about the year-end numbers that we have. As I said, that we've got about, as of today, we had about $13 million of cash at the end of the year. We're probably about 11 or 12 right now. We've spent a little bit of that drilling the wells that we're at right now. You can see that in the first quarter, we did about 2.6 million of cash flow. Give you an idea of how much that's grown. All of last year, we did 3.1 million of cash flow. So we almost did as much in the first 90 days as we did all of last year. So we'll be about 12 to 14 million of cash flow this year, be about 20 to 25 million next year. So that's the kind of growth curve that we're going on. You can see the net debt number is about $9 million, so we'll be way below 1x debt to cash flow. And we're just kind of rolling along. Capital expenditures, we're pretty close to capital, so that's the idea, is this will generate enough cash that we can just keep drilling wells. On the operating netback side, this is where the combination of higher prices and lowering our operating costs, we're now at about $33 a barrel. So we're getting paid about $65 a barrel, and we're putting $33 a barrel in the bank. So it's pretty highly efficient now when you look at where we are. Operating costs jumped up in the fourth quarter that you see there. That was a one-time expense of a special tax that one of the companies we acquired didn't pay. So we had to make a one-time payment in December. It was a little painful, but that's what that is. But you can see it's dropped right back down in the first quarter of this year. So this is southern Trinidad. Venezuela is about 11 kilometers off the coast down here. And actually Venezuela wraps around and it's about 15 kilometers to the east. All the yellow lands are the lands that we own. And the red lands are our operating producing lands. So the whole drilling program, those 208 drilling locations that I talk about are all on the red lands at this point. And then what I will talk about a little bit later is this big block that we've owned out on the east side for 3 years now, and we'll start drilling on that in 2019. We are the largest landowner in Trinidad. The refinery sits right here, and the big LNG facility sits right here. So give you an idea, this is about 30 miles from across this map, so it's not very far. Take you about 4.5 hours to drive it, but that's a different story. So this is just focus in on our operating land. You can see the wells that we've drilled. It's just a bunch more detail if you want to, and you can go on the website, and we actually take this down a couple more layers for you on the website if you want to. But we're just drilling everything up. It's a little bit boring on that side. You can see that we've had a 38% compounded rate of growth on our reserves. Even in the years we didn't drill, we actually saw reserves grow, and the main reason for that was the wells outperformed what the engineers thought they would do, and that was a result of new technology that we were bringing in, both from Canada and some from the US, but mainly from Canada on downhole pumping techniques. So get more oil out of the ground, and that was what was going on there. So we've got about 20 million barrels of reserves, and that's growing on a continual basis. So this is our production curve. So this is barrels per day, 0 to 2,000, which is the target in the timeline. And you can see we really didn't do much in early 2017. And then we started drilling wells right after we went public. We got the money, or on AIM, got the money and started to drill. And you can see where production now is up around that 1,800 barrel a day mark, and it's just going to continue to grow as we go along. So these are probably a lot more detail than you need, and you can spend some more time looking at them. But really what this is just layering in the first 8 wells that we did, because I get a lot of questions about how they're performing, how they perform block to block. And I think the key thing to think about when you think about Touchstone is this is a low-risk oil play. Like in Trinidad, you're not going to get a dry hole. The risk is, are you going to get a 50-barrel-a-day well, or are you going to get a 200-barrel-a-day well? So this just kind of gives people an idea of our different expectations. And you can see some of them, quite frankly, don't work as well as they should. You can do some work on them and make them work, and then you get a monster like that or like that are real solid. And I would love to say we could predict which ones we can do, but that's why we do a program, because some of them are just going to be better than the others. Talk about activity on the island. These are our competitors. So Trinity is, give you an idea, it's also listed on AIM. It's about 4 times our market cap. It does less production than us. It's only drilled 2 wells this year. We'll drill 12 by the end of the year. I don't get it, and that's why we're here. They do have a little more, they do have some offshore production, but I think what's happening is they've been on the exchange for a long time. Everybody understands that, and we're the new guys on the block, so we're just quietly putting up some numbers. Columbus is another company listed on AIM, and so is Range. And you can see they're not very active compared to what we're going to do this year in Trinidad. So it's kind of fun to be a big fish in a small pond there, and that's really what we're doing, and it's exciting. So I just want to talk about this other block. So this is the big block to the east, and I talked about Trinidad being on the up-dip end of the Venezuelan basin, and what we find is all of the gas production that Shell, BP, all those companies have, it's all offshore. It's kind of around the island. And then onshore, there's one gas field onshore. It was discovered in 2002. It's called the Central Block in the middle here. It's now owned by Shell. It was owned by BG. And at the time it was tested, when those wells were tested, I'm just going to flip ahead here, it's called Carapel Ridge. These were some of the largest onshore natural gas tests in the world, 62 million cubic feet a day of gas out of these wells. And so the challenge that I put out to the team was to find us a couple of more of these Carapel Ridge, Central Range block type on the land that we had, which is this brown outline that you see here. It took us about 6 months to get all the information. There's 70 wells that have been drilled out here, but a lot of the wells were drilled in the 1950s by the predecessor company, Texaco. And there's no public record in Trinidad of keeping all of the information. So it was a little bit of and that map in the corner it's a bit of a scavenger hunt to try to find all this old information and pull it all together. And it was about 6 months ago, we found an old geologist that had worked a bunch of these wells, and unbeknownst to us, he had kept all the information. He was kind of a crazy guy, and he now lives in Grenada. And anyway, we got the information, and it pulled up a bunch of these logs that we looked at, and it really kind of opened everything up, because we could take a look at what these looked like and then what the other logs looked like that were drilled in the 1950s. And as a result of that, we saw a whole bunch of them that looked quite obvious that should be re-drilled. And we couldn't figure out why they hadn't been completed in the 1950s. And the reason was this, is they were gas wells. And in the 1950s, there was no use for natural gas on the island in Trinidad. They were all looking for oil. There was no LNG plant at that time. There was no gas-fired electricity. So they just abandoned them. And once we got the logs, we could kind of see that. So what we're going to do now is go back into Carapel, or go back into our Oratois block and drill a bunch of these old Texaco wells that were drilled to about 10,000 feet. So they're big reserves. Like, if we can find another one of these, I was kind of half joking when I said to everybody to find me another one, but they've risen above that and certainly have identified it. So what we've now identified is 5 drilling locations that'll be drilled in 2019, looking for large gas reserves like this, that hopefully will be a step change. So there's 2 parts to Touchstone. There's this oil story where we're just drilling these, I'll call them boring wells, although they're performing better than we thought. And then there's this exploration aspect that we're going to start to drill in 2019. So the story's kind of unfolding, and it's certainly going to be one where we will be the largest onshore producer in Trinidad by the end of 2019. Some of the things that we've done a little differently, and kind of goes in line with the earlier discussion, one of the things they do in Trinidad and have done for the last 100 years is they separate the oil and the water when it's produced. They sell the oil, and then they send the water back to the jungle, just surface release it. It's got a lot of heavy ends in it, it's got chemicals in it, it's salt water. It's just not the right thing to do. So we've given an undertaking that we're going to actually have 0 effluent from any of our facilities by the end of 2019. And we actually started our first project that now in 2018, all of the produced water from 3 of our fields now goes back into the ground. So we're you know, it doesn't save us any money. There's no economic reason to do it. It's what we put in the category of just the right thing to do. One of the other things is the feral dogs that are down there. It's unbelievable, especially in the areas that you get there. I used to take analysts on the field tour, and we'd go around to our sites, and they'd all be really impressed. But the one thing they would always remember was these mangy dogs that were half dead running around at the compounds. And so what we did is we hired a local veterinarian, did a real simple program. We just spayed all the female dogs that were there, got them all back to health. As soon as they got healthy, the males didn't want to come around anymore, and they were keeping all the other dogs away. And it's just completely changed that whole little area that we work in down there from that point of view. So, you know, there's some little things that we can do along the way that I think make a big difference as we go along. So a couple of those things. So for us, value creation is obviously going to get cash flow up, keep the balance sheet clean, put in place some of these exploration programs that we have. We want to be a responsible producer, certainly on the island. As far as scalability goes, this is really repeatable. These wells, the 200 that we have, virtually all look the same. So it's a matter of us just drilling them up. And then I talk about the exploration upside. It's really, I've been doing this for 30 years, and I have never seen a technical team kind of have an aha moment like we did when we found those old logs. It was, you know, we'd sort of done the idea, everybody put the concept together, but that question was always there, why weren't these wells completed in the 1950s? And then when the logs got laid down and the well files got laid down, everybody kind of went, oh, that makes perfect sense. And I think everybody got pretty excited about it too. So the nice part about what we now have is, even if those exploration wells don't work, number one, we don't have them built into our forecast. Number two, it's not going to ruin the company. We're basically taking 20 to 30% of our capital program, pushing that onto the exploration costs. The other 80% will just go into this development drilling. So that's the biggest change since I was here last year. I think what I could say to you is we were doing what we said we would do. We've added this next component on, which is this exploration component, which we think is pretty exciting. On that note, I'll just turn it over for questions.
Questions, anybody? 2 at the back.
Is all your production sold and refined locally?
Yeah, so all of the production under the agreements you have with Trinidad, when you take the licenses or leases, you have to sell to the refinery. The disadvantage is that's upright, you're a price taker, but they do pay Brent price less a discount of about 13%, but they do buy it right in the field, and it's a US-based contract.
It's a sweet crude, is
It's sweet, yeah. Although it's quite ranges, some of it's heavier and some of it's lighter, but the refinery is set up for that. The one thing is that it's 160,000 barrels a day of capability at the refinery. The production from the island is only about 80,000. So right now they're buying 80,000 barrels of makeup crude. Most of that's coming from Russia and Nigeria, because that's the same quality of crude as what they're using. So they're really trying to encourage as much exploration as they can here to get that so that they're using domestic crude for that refinery. So.
Just one more question. Is it company policy not to have offshore exploration?
The question there without the microphone is it company policy not to have offshore exploration? And the simple answer to that is yes. We're not big enough. That's a big game. I mean, our wells in here cost us $850,000 to maybe $1 million. You know, the offshore wells are 20 to 25 million per well. And it's just, something goes wrong, that's $40 million. Well, the company's gone if something goes wrong. And we just can't do that. We do have that one offshore block, you might have saw that there. But what we're actually doing is drilling from onshore. We're just deviating the wells out to the block from on land. So it's basically onshore drilling. So.
All the way to Venezuela, are you?
Pardon me?
All the way to Venezuela.
I wish we could. 11 kilometer horizontal would be a bit of a reach, but you know, that's a little bit of a joking question, but we are positioning ourselves to make sure that when Venezuela blows up, and it will at some point here, it will be an area that we'll look at very quickly. I mean, it's been undercapitalized for 20 years. And if eventually there is an open market, yeah, we're one of the naturals to move in there because we'll know exactly what the reservoirs are. I think it's going to probably be one of the biggest opportunities for players like us that go into old fields. Venezuela is going to be a huge opportunity at some point. I've been saying that for 3 years.
Question at the very back.
Hello, terrific presentation. I've got two questions. Firstly, you mentioned the difficult period, 2014 onwards, when a lot of smaller companies got snuffed out. What were you doing different or better during that difficult period? That's my first question.
Okay, answer to the first question was, we've got a pretty active hedging program that we put in place. So we always have about a third of our production hedged. So at the time that it rolled over, and you saw how sharp that was, we had about a third of our production hedged at $70. So quite frankly, what happened is that generated about $7 million of cash for us. And that's kind of how we got through that. So even today, we've got 500 barrels hedged, and we just kind of roll about a third of our production on a hedging basis. So that was one way. And the other way is on our banking agreement, there's no principal repayments, so it was just interest. And there's also no covenants. You might have saw that we put a press release out a couple days ago where we renewed the banking line and they dropped even more covenants. So we don't have like an EBITDA covenant. I guess we do have an EBITDA covenant. We don't have a production covenant. We don't have all those other things that you can get offside of really quickly. The combination of those two things and some quick changes that we made in the G&A costs really saved our bacon.
Thank you. And other question was, you touched on the significant exploration risk. You're only doing land-based drilling. You still have a significant risk. You're encountering reserves, but not always in the economic quantities you expect. So to what extent is your company investing in drilling and engineering expertise to understand the characteristics of these new wells that you're drilling in order to get the best out of them?
So, and I would say that our philosophy on the drilling is not to be on the cutting edge of technology. What we would rather do is be really knowledgeable about what's working other places around the world and then bring it in and apply it. because we don't really have a big research and development budget. So, so what we do is we work with Schlumberger and Halliburton and do a lot of rock gathering, sidewall cores when we're drilling, collecting the samples properly, and then send them off to them. And they are a great resource because they're working all around the world. So you send it to them and they go, oh, I've seen that before. That's like in Colombia, or that's like in Nigeria, and then they come up with some solutions. So we kind of let them do it. And the trade-off is we use them for services like mud services and logging. So we kind of poor boy it on that. But the technology here in Trinidad is really from the 1980s. 1980s, 1990s. I mean, doing directional drilling has been going on for 40 years, and we brought the first directional equipment down here 5 years ago. So that's the real advantage that we see.
Thank you very much.
Thanks for the questions.
Question just in front there. Yeah.
Trinidad actually is quite a mature area. It's been for quite a while, you know, whether it's oil or gas. And the cost base or operating cost, you're mentioning about $33 a barrel. Is that compared quite favorably with shale? And can you comment on that?
Yeah, so you're right. Oh, I guess I don't have it on there. It's been around since 1908. That was actually the first discovery of oil in Trinidad. So you're right, it's been around for a long time. So if we look at operating costs, our actual operating costs are about $19 a barrel. That net back is the $33 number. So actual operating costs are about 19. If you look at the shale oil, they are a little bit lower. They're probably $10 to $14 a barrel. But the front end of that is the capital costs going in. So what happens is we spend $850 grand US to get a 200 barrel a day well or 150 barrel a day well. And no fracking here. There's nothing, you know, really high science about it. They go in and drill these horizontal wells for $7-8 million, and they may get 1,000 barrels a day. But the economic return, when you look at all-in cap cost of seismic land, of facilities, of all those kind of things, our rates of return are in the 70-80% range. So I would argue that these are probably more economic. But you know, the advantage of the shale oil is you get these big, long reserves. You can do, you know, you can billions and billions of barrels. So there's a trade-off. I think if you look at full cycle economics on shale oil, you'll see that it's actually just a grind of cash at these current prices. Like you're putting in as much capital as you're getting out. And on the tail end of the curve, that's where the investors will make the money, like 10 or 15 years out, once these wells are down to 10 or 15 barrels a day. And we're starting to see that in the States. We're starting to see cost of capital go up dramatically for the shale players. You know, they're having to borrow now at 12-14% interest rates, which is a big difference.
So just on that follow-up on that question is, what's the recovery rate from the field? And you use enhanced techniques to recover as much as you can. So that'll drive up the cost base, obviously.
So we're not doing any enhanced oil recovery here. We're just finding areas that haven't been drilled, sections that haven't been drilled, and we're drilling them up. So we're still in primary recovery here, and that's why you see the operating costs low. There's another step here where you could start putting water back into the reservoir and do water floods. So the general rule of thumb is you should be able to get about 15% recovery factor on primary. These fields right now are at about 8 to 9%. So we can get another 6% just doing primary recovery. And to give you an idea, we think we've got about 1 billion barrels under our land. So you're talking about something that's another 60 million barrels just on primary. And then if you go from primary to enhanced oil recovery, you should be able to take that recovery from 15% to about 30%. So you double the reserves again when you start doing a water flood. We have done some science on water floods, and it could be down the road, but we're not there. We don't have any of that booked yet. That's kind of the next stage for Trinidad to go to. I think that's actually the big step change for them. If they want to get back to 150,000 barrels a day of domestic production, they're going to have to put in place the right regulations to enhance oil recovery, and they're working on it. They're talking about it now.
Final question.
I've got two, if I may. The first one is that I noted when you were speaking in November of last year here, you said that you were drilling wells you drilled 10 wells every 6 months. You had 208 prospects, and then you discussed what you've just been discussing about. They might be between 20 barrels and 200 barrels a day. But I noticed that your slide 14 only refers to drilling 4 wells in 2017, and yeah, 5 wells drilled to date. But how do I compare that to your statement that you drill 10 wells every 6 months?
So you can do that. Like we can drill basically, that is the plan. If you look at what we've done this year, we've drilled it'll be 6 wells in the first 6 months of this year. And what we're doing is we're just spreading out capital, because you saw that we're basically generated 2.6 million and we spent about 3 million of cash. So what we're doing is have the drilling program to match when the cash is coming in, because we don't want to do any more capital raises.
Sounds as though it's a bit slower than 10 a year. 10
Yeah,
every
I think we'll
months.
do 10 this year. We'll probably do 12 this year. And then next year we'll maybe step it up to 20. But
Right.
I'm still not comfortable that $75 oil is where we're going to be. We're still running all of our economics at 55. So in answer to your question, yes, it's been slower, and that's been by design, not by operational.
Right. And my second question is the next slide, slide 15. And you contrasted yourself with Trinity Exploration. But Trinity is an offshore driller, mainly. So
Well,
could
actually, they're not. They're actually they're 2,500 barrels a day, and they're about 1,000 barrels a day offshore and about 1,500 barrels a day onshore. And they're by far our biggest competitor onshore, and they haven't drilled an offshore well in a couple of years. So you're right, there is a difference. But when you look at cash flow, you look at the model, you look at debt, they trade at, a multiple that's 4 or 5 times higher than us. And they've done a great job. Like they restructured it and they've drilled some really good wells. I'm not saying that. I'm just saying there's still a value gap between our peers as far as we're concerned.
There's one more question behind. I did promise him, so.
Thank you. You said Trinidad was your primary customer, and their refineries are quite old. What's the risk of the refineries not being able to cope, even though they're purchasing oil from Nigeria and Russia? Because I don't think they put much into maintenance of the refineries.
So you're right, the refinery is really old. It was built by Texaco in 1950. They put about 1.5 billion US into it over the last 3 or 4 years. So they have done some maintenance on it. But what we've done is we've also got a takeaway contract with Shell on the East Coast, so that if the refinery is to go down, there are other markets to take the crude to. Now, all of us would be doing that, because that's what we'd have to do. But there are other alternatives if you chose to do it. It'd be kind of a mess. There'd be a line of trucks lined up to get rid of it, but I think there are some alternatives. The refinery also has, and I may have this number wrong, but it's a mind-boggling storage number. I think they've got 1.5 million barrels of storage capacity. So they've got a lot of capacity there to deal with upsets at the refinery, that they can still buy crude on a weekly basis.
I think the LNG company is Phoenix Park in Trinidad. That does quite well.
There's 2. There's Atlantic LNG and Phoenix Park. So there's 2 LNG producers.
I think they do quite well. What investment would you put in if the exploration for LNG in the park pays off?
So if we're successful and it's gas, what we'd like to do is we would like to sell to those guys to run it through their LNG facility, and then we could get LNG prices less a deduction for the fee. We've talked to Shell about that. They're obviously receptive because they've got excess capacity, both at the Evergreen Carapel Ridge facility and at Atlantic. The only thing I can say is that Shell likes making money, so those fees are probably going to be higher, and they're going to keep most of the gravy versus us. There's also a local power company on the island that generates, all their electricity right now is generated by gas-fired generators. And so there's also a local market on the island. So there's a shortage of gas on the island. Selling the product is not our problem in Trinidad. The real problem has been just getting properly capitalized to get the wheel going on the drilling side and get to that 10 wells a month, or 10 wells a year, every 6 months.
Paul, thank you very much indeed.
Thanks.
Thank you.
Thanks.